Hey guys, Unicorn Trades here. I am going to tell you today how to make the most gains out of a play. Um, this is going to be a video you're not going to see from other people because the general concept or consensus out there on how to make plays is not how computer algorithms work. And the algos are built by people that get paid a lot of money because they are designed to maximize profit. And so, um, this is a trading system that I use, and it's how to maximize profit. You hear people say, let your winners run, blah, 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 you know, cut your losers quickly, cut your losses quick. But this is a video on my system or my opinion on how to bleed a stock. And when I say bleed, that is get every ounce of profit out of it that you possibly can with zero risk. And that sounds insane. I understand that, but this is how to do it. And I've done it time and time again, and there is a ton of calculation to do it. That's why algos win. I mean, they wouldn't run an algo that doesn't win. Okay, and so you have to think in the sense of fluidness and liquidity. Not liquidity in the sense of number of shares traded and the volume of the stock, but you have to move your position continuously and adjust your position based on outcome that you desire. And so this is a concept you're not going to see taught in any video, but it is how I trade and how you can make monster wins turn into even better wins. So the general concept is, well, I'm going to set this as my max loss, this is my max gain. I want to, enter here, and I'm risking 5% down or 3% down. I'm planning on 10% up. I sell on 10% up. That's a very dumb way to play. Okay? Because when you set a maximum loss, that's your risk. When you set a maximum gain, you don't know. You don't know what the maximum gain is. You know what the maximum loss is, but you don't know what the maximum gain is until you sell. And I am of the opinion, my key phrase is my max loss is my minimum gain. And this is what I do. The key thing is to find a good entry, a strong entry. And it has to be so strong that you can hit it with a 1/3 of position, with 2/3 position set back for a small average down. You can see probabilities. Probability of you making a call at the bottom is not so great. The best thing to do is to create a situation where you can average down or load. I prefer to call it loading a position. And if you buy, let's say here, and the next day the stock drops to here, it's probably 1% here. You need to say, well, okay, I was 1% wrong, so I'm gonna add here, to cover that 1% gain, the loss. And then if it goes down even further, you're going to say, well, okay, I'm going to add triple position, because I was 3 or 4% wrong. But you're not going to enter position and say, okay, I bought here. I am dead on the bottom. full position, everything's loaded, and there is zero downside. That is not probabilities, and that's not risk management, and that's not understanding how things move. You cannot say that, like, maybe 1 out of 100 trades you literally would buy it on the bottom. Here, actually, that was a pretty easy play to buy on the bottom because there's a heavy price point, which is the gap top off of this candle here, and those can create bounce points, and the next bounce point will be a gap bottom. But that being said, you have to have a probability on your call. Okay, there's a 5% chance that I'm wrong here, which would be the 5% downside. So the way to bleed a stock, a mosquito or a leech does not drain all your blood out on the first bite, okay? And if you want to get maximum gains, you're not going to get it on the first play. It's not going to happen. You look at any professional, like any trading guru that you see out there, they are not calling tops. I sold this thing on the dang top. That was balls on. All right, pardon my French. That is a play. I bought it here. Boom! I mean, it literally sold it at the top. I mean, within a couple cents. But that was only a quarter of my position. So, how to play this? Number one, I'm going to show you a lot of charts here, real quick. But I mean, that is dead on the day. Boom, done. I'm out. Like, that is crazy. That is like dead on accurate for that day. But what we want, and this is what you see from a lot of day trade videos, what I want, I don't want to make an 18% gain, which is that was that move. I don't want to make an 18% gain and I'm like, I'm out, I'm cashed out. You know why? Because an algo doesn't do that. Because an algo doesn't miss out on the 15% gain that moved the next 3 or 4 days. Okay? What you want to do is you have to figure probabilities. You have to say, here's my buy. Well, I had a lot of buys and sells. But here's this current buy. And what's my max loss? What's my risk? And that, like, the risk is not total risk. If your risk and profits are static, you're playing wrong. If I say my max risk is 5% down or 8% down or 7%, 5%, whatever that move is, I'm not going to calculate it right now. But if I say, okay, that's my max loss, well, when the stock gets to here, like, my max loss shouldn't be here. My max loss should be break even. Or, in my case, I set a stop up here. My max loss is a 2% gain. My max loss is a minimum gain. Alright? That's the first step. A really good way to do this, I'm going to just throw numbers out there. So let's say I loaded $10,000 here. Stock moves up 18%. I made a balls on good call, an entry. Moves up 18%. If my break even, I had originally set my stop here at 5% down, and I want to change my break even, to 0, I take off whatever the gain move is up here. So let's say I take off $1,000. That $1,000 would take off, so 5% of $10,000, $500. Let's make it easy. No, we're gonna say 5%. So $500. So I take off $500. Anywhere in here, I take off $500. I set my stop at break even. My max loss is 0. But I still have a huge, huge margin of error on the upside. It would suck if this thing tanked out the next day and came down to 0, break even. But what's better? You're preserving capital. You have your max loss is 0, and all you had to do was take off $500. Now, depending on your trading fees, whatever. Let's say 600, whatever. Take off 1,000. Who cares? All it is when you take off that max loss, you can raise your stop up to break even because you've already captured the gain. You're in a net zero. You're in a net positive. Well, not really net positive. You can make it net positive easy. We'll just say you're in a 0 situation. All you have is possibility of gain, and that is where you want to be, and that's hardcore. Okay. After you take off that initial position, which I took off a quarter, but after that initial, I took off a quarter because it's outside the Bollinger Band, which is right here, and I'm just going to take my money. But the goal is to you have a net risk of 5%, then you have a net risk of 0%, and then you have a net minimum loss of or max loss of minimum gain of 2 or 3 or 4 or 5%. And then the point is not to sell your entire position. You don't want to well, my entire position is that. Well, I have a quarter of my position, maybe stop loss here. But the goal is you want to bleed as much as you can. The goal is not to get stopped out and set your stops so far away from the current price that you cannot be stopped out. But you're still positive. I'm going to show you a couple things real quick. Other ones. This was like a brilliant play. And I'm a novice. I don't know anything about stock trading. But this is just what I did. You can play the stock better. You can always play it worse. But this is a pretty solid play. But the point being is that you have a max risk. When you're correct, your max risk becomes 0. When you're more correct, your max risk becomes positive, and then you don't necessarily have to move your stop up constantly. The calculation you want to have is that your stop doesn't want to be too close to the average moving on the stock. So if you're moving 5% of the stock, you don't want your stop in at 3% because it's going to get stopped out. You want to bleed the thing for as much as possible, and you're always in a positive position, net positive. You can't ask for anything better. That's letting your winners, quote unquote, run. You're letting your winners run is not leaving your stop loss at break even. So you pull a little bit off, and then when you break new highs or you're way positive in your trade, you can move your stop up. Okay? But I usually only move my stop up with a portion of my position. And when you get to a situation where the momentum on the stock is huge, but it's massive. But I had a stop. I actually had a stop in here on my entire position here, and I actually sold a little bit earlier in the day. I think another quarter position out there, and I think 50% of the last part of my position was here, just because I felt like it was a little extended. Whatever. This thing could continue to run, and sure enough, it did. I could have made even more money. But this brings me to the real key thing. If you have let's say, ignore that text. Let's say you have 10K in here. If you move out, let's say, 2.5. If you move out 2.5, but your remaining 7.5 is at break even, because now you're able to move your stop up, You know, and let's say you're here, and you set another stop for another quarter. Well, you got 50% in the position. If you move out another 2.5K there, you got, a quarter of position in. But the key is the larger your initial purchase, the more the more leverage and room you have. If this was, let's say 100K, and you have an 18% move on that, so you're only going to take out 18. Right? You can set your stop here, and you can bleed this for even more. Because what happens is, as the stock price moves up, the momentum starts to wane, which means your percent gain dissipates. It's not 100% accurate, but the point being is that, like, well, I had 100K that gave me I got an 18% gain on it. That's 18% move. Then you have a 5% move. Then you have a 5% move. Then you have literally a 1% move, and then you have a 3% move. As the stock moves up, the percentages drop because it creates the need for more dollars to come in order to keep moving that percentage-wise. So as the stock moves up, the percentage move is going to dissipate. Usually. I mean, you play a small cap stock, one player can drop a huge order to push the thing. So we're talking large, mid-cap stocks that have huge momentum and a lot of buyers and a lot of hedge funds and institutions behind it. It's going to wane. And so your position should kind of wane at the same time. But if you're up, let's say you're net positive on the whole trade here, like, you can just leave the last 50% in, or the last quarter in, and just let it ride and see what happens. But, that's bleeding the position as much as you can. It's not necessarily exiting out. The goal is to be in the position forever, in my opinion. Forever. Like, the more capital you start out with, the more leverage and the longer you stay in. You're not going to hear that too often. But if you talk to real hedge fund guys, they would probably agree. The example would be, let's say you had 100K here, and you moved out of 18K here. I don't know what the move is, but let's just say it. Would you want to move out the rest of your entire position right here? Oh, we're just going to close out the rest here. That would not be smart. Okay? Because you would have missed out on a 100% move. Okay? So the goal is to bleed it as hard as you can for as long as you can and be net positive. You never know where the top is on some of these really strong moves. So the goal is to be in net positive as soon as possible with minimum risk of getting out of the stock and not closing out the majority of your position too soon. If you have $100,000 in and you only made 10, and when you could have made another 50, whatever. But if you close it out at 10, you're never going to have the possibility of making that 50. That is a key. Second key is never sell. Always set a stop loss. Okay? In this case, I did sell because, well, actually I can't say that for sure. I may have set a stop loss here that was super tight. If you want to sell, don't. Set a stop loss you know, 1% or 2%. This thing moved 18%. I could risk 3% loss on the top of the move. If you sell, let's say I felt like the top of the move was here. Oh man, I'm out. I'm out. I'm taking my 1/4, you know, so I can move my stop up right now. If I had done that, I would have missed out on a 3% move. Right? So what you do is when you feel that you need to sell, you set your stop slightly below current market prices. You have to learn this. It's just a feel. You know, 1, 2%, something like that, depending on how volatile the thing's moving. But the reason it's the same concept. If I'm here and the stock goes to here, I don't sell my entire position. Why don't I do that? Because I don't know if it's going to go higher. So if you're going to create a sell here, why would you sell? Because you don't know if it's going to go higher. So always set stop losses on the position. So on my 1/4 position, create a stop loss. My stop loss is 1% below where the current price is. I don't know if it's going to keep pushing. It might. And, you know, if it keeps, like, let's say I feel like I'm going to get out here. Oh man, I'm in my 10%. I'm out. Don't. Set stop loss 1% below. You're going to make 9% instead of 10%. But, you know, there's 5, 6, 7% more that it moved. And then you just keep moving that stop up at the same metric, 1% or 2% below. Keep going, and then it'll trigger. You want to sell off that amount, but don't sell it at market order. You know, don't say, well, I need to get out now. Like that's the dumbest thing you can do. And you do not know when you do that. You say, I am calling the top right now. This is the top, and you don't know. 90% of the time, you are going to be wrong. That's not the top. So instead of saying this is the top, say I'm going to risk losing 1 or 2%. And this may be the top, but who knows? But you should always, in my opinion, sell stop loss. Set a stop loss on your sells. Don't just sell. Because the worst that's going to happen is the stop loss triggers, and you sold it 1% lower than what you wanted to. But the best thing that can happen is the thing moves another 10%. You know, the second that thing moves 2% up, and you move your stop loss 1% up, you're net positive. So, don't do that. Don't just say you're net even on that one. But you know, if it moves 3% up, then you're 1% positive. Just set stops, set stop losses on your sells, because you never know when it's going to keep going up. And so, that's key point number 2 on bleeding as much as possible. I don't know how many times I've set an order like that, and like the thing just keeps pushing. You know. Or it triggers immediately. That's the other thing too. If it's tanking off and I was like, oh, my stop loss is $19 and it's currently at $19.20, while I'm putting in the order, it drops to $19. Just boom, I'm done. I previously said that my order was $19. It hit my order while I was putting it in. Done. Don't drop it to $18.99 or $18 whatever. Don't drop it, because it already triggered your predetermined decision that was when you wanted to sell, and it hit it. So you don't second guess yourself on those positions, because what happens is you're going to set it down to $18.20, you're going to set it down to $18.50, you're going to lose. You already said this is what I'm willing to lose, and it's there. So just lose it. Next is so this will show you a really good reason for this, and this is a stock I play frequently. Originally I started playing this stock, and this is actually one of the stocks that prompted me to develop this methodology. This little star tick here at around $5 was my initial purchase on the stock, and thing went up 300%. Okay. I actually don't have a tick here on my sell. I do know that I made a decent amount of money, but it was probably under 20% on a 300% possible gain. And this is where this methodology has come in. You know, I have a buy here, sell here, and it's a week. But my current methodology, as you can see, is here. And I did have a buy here after hours. That's why it's way above the doji there. But you know, it was an earnings situation, and I had been watching it for a while, and I just knew that I was waiting for the earnings and calculated earnings, and you know, played off that. Same situation where, you know, you're in after hours. You know the thing's popping. I'm pretty sure it popped pretty hard after hours. But you know, I set my max loss below the EMA, which is here, and you know, as soon as it popped the next day, or you know, I knew it was gonna pop, I sold a quarter position, which allowed me to take my max loss stop, and move it to my open. So I'm and then zero, you know, in net zero position. And I did not play this one 100% correctly, because I actually sold them. I know that actually on this one I did sell a majority. This is where I was actually feeling this whole situation out. I did sell a majority there, but the smart thing would be to sell a quarter here. I could have sold even more up top. Okay. Instead, I sold. I bought. I sold a little bit here. You know, my net loss was originally on my two buys here. My net loss was below this point here, but you know, I sold a quarter out or whatever so that I could move my net loss to break even. Actually, you see my stop at 2049. If it had come back to 2049, I break even. So you have to you open always with a risk. With the calculations, how much risk. And these people that say, well, you set this much risk and the stop loss here, and then I just cash it out, or I just keep going up. The goal is to stay in it as long as possible. If you're in a good, strong moving momentum stock, like this is really strong momentum. I mean, the momentum actually started back here, but you know, if you're in a strong momentum stock, like you just don't want to sell. You want to bleed it as much as possible. And you're okay, so you're gonna lose sometimes. You could have made 20%, but instead you only made 10. But you do it consistently, and there's going to be that one time where you make 50% on the move because you didn't keep moving your stop up to the point where it just got triggered out on a bad day. You know, you're like, okay, I'm 10% up in this thing, I'm 20% up in this thing, and my stop's here. Let's go back here. I'm 20% up, I'm 20% up in this thing. This is such a good example right here. You know, I buy in here, I sell a little bit here, I'm net zero, I sell a little bit here, I'm 10% up. My stop is still here. Thing moves another 20-30%. You know, had you kept moving your stop up, in this case it went parabolic, but had you kept moving your stop up and it came triggered down, you're out. Same deal here. Well, okay, I set my stop here, so I sold out. Well, set your stop here. It's kind of like Darvas boxes or whatever. But, you still had even more move here. So the goal is to set your stop so far away that you can capitalize on all the gains. Because the goal is to bleed as much as you can out. With the possibility that you don't sell outright. And you break even, or not break even. But you only capitalize on 10% when you, at some point, were up 30. And some people will say, well, that's just being greedy. It's being greedy. you need to create probability to create the largest momentum moves. Because had you done that through this move here, you would have made 200%. Okay, if your initial position was $10,000 and at this point you were only 5,000 in it, and you just said, hey, you know what, I'm 5,000 up, or I'm if this is a 20% or 30% move, let's say 20% move, I'm 2,000 up, I got 5,000 in this stock now, and boom, you just let it go another $2,000 or $3,000. So the question is, being greedy is not actually bad, because it's being greedy when you don't have a net positive position. So and when I say net positive, I mean you're not actually positive. You actually haven't gained until you've exited, and that's why you take a little bit off and you let the thing run as hard as you can. Because you're like, one stock could make your entire year. That's it, one position, and you do this enough times, you're net positive. You're zero at least, and you're net positive a small amount. I'll show you another one, really good one here. I'm still waiting on this one. May run, may not. Who knows? EGRX. I just started playing this one recently, but I do have my buys right here. I actually don't have a sell on this. My stop is right here. So I'm actually net positive 2 or 3%, 1 to 3%. I don't know. I'm not calculating right now, but I'm net positive 1 to 3% on the trade. There's no way I can lose it. There is if it opens, like, because of bad news, way below, gaps down. But the second I sell, I have not trimmed. If I trim this 1% difference or 2% difference and leave my stop there, I'm net positive, unless this thing opens way below. That's the only time you can really get crushed, is if something comes out where it totally moves you way below. But that's the risk. That's the risk. That's a way out there kind of risk. I mean, it doesn't happen all the time. But the point being is that my stop is set so low that this one would have to retrace the entire gain, and if it does, I'm still net positive 1 or 2%. So my max loss is my minimum gain. And just looking at this thing, I mean, it's gonna go. But that's where the position you want to get in. Here's a really good one. Yes. Is it? No. Yes. I actually posted a video on this telling people to buy this right here, because it was a double doji. Like, it just set up so perfectly. Double doji on the 20 DMA, 50 DMA, and 8. Like probably one of the hardest resistance points I've ever seen. Had you loaded that position, and I did. I had bought here, I sold here, I bought here, I sold here. This is before I knew what the heck I was doing. But had you loaded here, the top of this move is 75%. I mean, just crazy. But had you loaded here and set your max loss below, which is almost impossible based on the setup, your max loss of 5 or 6 or 7%. When the thing popped a little bit, you sold out enough to move your stop up to 0, and then you wait. If the thing comes all the way back down to zero, you could have made some money. But it did not come back down to zero. Instead, it went up 70%. And had you sold off just a little bit here to set your stop up here, your max loss was your minimum gain of 5 or 6%, and you let it run. You know, heck, even had you let it run this entire time, you'd still be net positive, you know, a considerable amount of money. Let's see. How do you set your stop up? You know, after that little bit of gain or whatever, you know, you're just net positive. You know, even today, you would still be net 28%, but you would have capitalized some of this gain here. I mean, who wouldn't? But the point is, you want to be in a trade, a winning trade, as long as possible. And if it's coming down, it's coming down. Oh, I'm totally out of the position. I'm totally out of the position. Sure, you could be out of the position, but you probably would have been out of the position when the thing tanked off down to the previous consolidation period. As soon as it broke that consolidation period, you'd be out. At that point, you made so much money, who cares? So, that is just, you know, how it works. A good way to play. You know, you have a max risk initially. Sell off a little bit of your, if you're correct, to get your max risk of 0. And then as it moves up, you can trim a little bit, you know, and that trim should be with a stop loss order. It should not be with a sell, because you never know when it's going to go up. When you set your stop loss, you know where your bottom is, but you don't know where the top is. So don't say you know where the top is by just putting in a sell. And like I said, the only time they can really get you burned is if it gaps down over after hours or something like that. But pre-market, whatever. But you know, the key is, you know, get in a winning position. Say, oh, okay, I'm making 5% on this trade. I'm making 5% on this trade. Just let the thing go. When you're 20% up, okay, take a little bit off. Take a little bit off. But the key is, if you want to win hard positions, long-term, super hard gains, if you trim 50% here, that's less capital that can possibly move up. You know, and as the thing moves up, the percentage move is less and less. So you're hurting yourself on both sides. You're getting less percentage per day, and you have less percentage of your initial position in the stock. So the goal is to keep the largest percentage in the stock. And one way to do that is to set stop loss, because you never know if it's going to actually trigger for your actual sells. If I'm going to capitalize, just don't sell. Like, that's stupid. I watch people, oh, I'm going to sell. Like, you never know. You never know when things going to keep going. Say, risk 1% to possibly gain 10 or more, or 5 or 2, 3. Risk 1% to gain 3. Who cares? But the point is that your risk, it's the same thing when you enter. I buy here, I'm risking this much because I think it's going to go up. Why would you create an order to sell? You already created the order pattern right here. Why would you create an order just to immediately sell? You have to make your intra-play trades similar to your overall position play trade. So because it's told that you're using a different methodology, that would be the same as saying I'm going to buy it, you know, here, and I'm going to sell it here. Well, that's dumb, because you just missed out on that. Like, don't do that. I've learned. Bleed stocks for as much as they can give you, and turn your risk into 0 immediately, as much as you can, and then just make money. So good luck, guys. That is my trading philosophy on strong momentum stocks. So, and this will generally not work on super small caps because one person can come in and just hammer the price down too easily. So, strong momentum stocks, decent strong stocks. So, good luck with that, guys.